Welcome to the risk events video for the week beginning the 27th of July 2015. Now, it's a fairly quiet week this week on the risk event side. There is one or two events that potentially could cause some pretty decent tradable moves, and there's one in particular that we're going to be looking out for as our kind of most tradable opportunity of the week. So what we're going to do is we're going to go to we'll go through day by day. We'll start with Monday the 27th. As you can see, we've got only a couple of big major high impact events. We've got one from the Eurozone, Germany, the German IFO Business Climate Index. We've also got core durable goods orders from the US. Now, the European data last week was actually a little bit lackluster, caused a little bit of a sell-off in the euro. There was actually some massive option expires at 110 and 109 on the euro dollar, which kind of kept the price in kind of a range between those two levels. And as the markets opened on Friday, I think it was, when all the European data was due out, it was kind of stuck around the 110 level. And then as that data came out lackluster, it then sold off back down towards that 109 area. So effectively, the European data, it's going to start to have more of an impact now. I remember over the first half of 2015, we weren't really interested in European data, but as time goes by, particularly as we get towards the 12-month anniversary, which is probably quite a few months away yet in March 2016, but as we get close to that date, the European data will take on a little bit more significance. Still not quite tradable, but it's definitely getting more and more market moving. So the German IFO, not really too concerned about it, but it will be worth keeping an eye on just to see how that comes out. Then we've got core durable goods from the US. This is, of course, positive data on the very positive US dollar currency. We can expect this to support the dollar, of course, if it comes out as expected or better. If we get a worse reading, it's probably not going to change much. And the other thing to bear in mind with US data this week is that we've got the FOMC statement coming out later in the week. So these data points, like core durable goods orders, probably not going to get too much attention for too long. Even if there's a spike or reaction in the price, the market's not going to play it out over a sustained period of time because they're going to be waiting for that FOMC statement. So don't pay too much attention to that. And even if it's negative, it doesn't really change the big picture on the dollar, which, of course, is still long. Now, if we move towards the 28th, Tuesday the 28th, this is, in my view, probably the biggest risk event of the week. Now, I'll explain why. I'm talking about UK Preliminary GDP, the quarter-on-quarter reading. Now, as I've just mentioned, we've got FOMC coming out later, so you'd think that FOMC would be much bigger than UK GDP. But in the current environment, FOMC, not really too much has happened since the last time Janet Yellen spoke, and so we're not really expecting too much of a change in the FOMC rhetoric. We're still expecting to be on par, on course for a 2015 rate hike. Not quite sure when. The market's pricing in somewhat time in between October and December. September, I think, it's like a kind of high teens probability at the moment. So it could basically be, bear in mind, we're at the end of July now, so you've only got 3 or 4 months of the year left. So if the Fed are going to hike in 2015, it's got to come pretty soon. So we'll talk more about that in a moment. So for that reason, we'll come to the UK GDP. Now, this is a big one because the Bank of England have been very hawkish lately. We've had some pretty decent data out of the UK, with the exception of retail sales last week, of course, which caused a mild sell-off on the pound. But this GDP figure is expected to be 0.7 versus previous of 0.4. That's positive. That's strong, very supportive for the pound. So I expect the pound to be supported into this event. Okay, so expect the pound to maybe go up a little bit, at least be supported into the event. And if it comes out at 0.7 or higher, that's just another reason the Bank of England have got to hike rates. Provided that they're right with their inflation forecasts and that inflation will hit 2% by the end of 2015, wage growth is smashing it. GDP is looking pretty good. There's no reason not to hike, basically. The UK economy is looking fairly good, fairly solid. And this is just going to be another reason. So I think the market could take this as one of the biggest risk events of the week. And I think we could see some pound strength coming out of this. But again, only look to trade the pound, only look to buy it against those weaker currencies. Don't try and buy it against the dollar, because, of course, that's one of our strongest currencies as well. Look to buy against those weaker currencies. Think things like Japanese yen, Canadian dollar. We'll talk about the Canadian dollar a little bit more later on in this video. But basically, that's the general concept that you want to apply. Of course, if GDP comes out negative, we probably will have a similar reaction to what we had with retail sales last week, when the market kind of got in a bit of a mood and sold the pound off because, it's just kind of maybe taking a fraction of a step away from those rate hikes. Now, again, I don't think one bad data point is going to change the Bank of England's view. I think the Bank of England are focused on inflation. I think the Bank of England are also focused on wage growth. I don't think things like retail sales matter too much. GDP, obviously a bigger one, a bit more important, but again, it's not one of the things they're really focused on. So even if it's negative, even if it comes out below 0.7, you could take short-term advantage and trade the pound short. Definitely, you could sell the pound, particularly against the dollar. But again, bear in mind, it's only probably going to be a short-term move. So don't be trying to get hundreds and hundreds of pips. Think of it in terms of a day trade. But generally, I'm expecting this to come out on point, 0.7. Or if there's going to be a surprise, I'll probably expect it to be an upward one. And if that is the case, then again, you want to look to keep buying the pound through the week. So that's how I prepare for that. So that risk event there, the reason it's the biggest one is because it could be tradable either way. Because the market's going to have has got this build-up of anticipation around UK data now because of the Bank of England, because of the time period that we're in. So if it's bad, they'll probably sell the pound off in the short term. If it's good, that'll probably keep the pound supported. So However you want to trade this, if you want to trade, if it's negative, you can sell the pound in the short term. You could even look to buy the pound back at a better price if you're a longer term trader. So there's lots of different ways to approach it, but ultimately that's because the big picture that we've got, which is the pound's probably going to go up, Bank of England are probably going to hike after the Fed. The pound's going to be very well supported no matter what the data and what happens to the data overall in the long run. Later in the day, you can see we've got some CB consumer confidence, but again, as we've already talked about, this US data not going to be so important because we've got the FOMC coming up later in the week. Now, that brings us to Wednesday, July the 29th. Now, you can see here, there's two events. First of all, you've got the FOMC statement and you've got the federal funds rate. Now, no one expects the Fed to hike their rate this week, okay? But, this is a big but. The Fed now we're in territory now where the Fed could literally hike at any meeting. Now the market's pricing in probably an October to December hike. Okay, that's what the market's pricing in. The other one is the September hike. I think that's got about 20% or 15 or 20% probability of happening according to the markets at the moment. So not the highest, but bear in mind the Fed can do whatever they want, and if they deem it appropriate, they can hike any time. So we need to be on high alert for any changes in the rate from this point onwards. Now, what that means is you want to keep a close eye on this meeting, because if they do, it's a tiny probability, but if they do hike, it's worth watching this meeting, because if they did hike, there are pips to be made buying US dollars. You want to get in at an immediate aftermath of that. The thing's going to go up probably all week because it's going to be so unexpected. So you want to definitely, this is probably the easiest pip you'll ever make if it happens. It's a very low probability of happening, but unlike the last 6 months where there's absolutely no chance of the Fed hiking, we're now in the period of time where there's a little tiny sliver of hope or possibility that the Fed could hike at any one of the meetings from now till the end of the year. So just worth keeping an eye on, basically, because it's easy pips. Everyone likes free pips. Just something to bear in mind. Of course, the big focus in reality will be the FOMC statement. This is what we want to keep the biggest eye on. What are the Fed going to say? What are their projections? What are they going to, how are they thinking? What's their official statement? I don't expect this to be too different to the stuff they've said recently. I don't expect it to deviate too much away from what Janet Yellen's already said in recent statements and press conferences. So I don't think it's going to be, the general expectation. I don't think this is going to be too much of a market moving event. The only reason it would be is if something unexpected happens. And if we get that unexpected happening, either an unexpected statement, an unexpected move on the rate, then we could set some big moves on the US dollar. So you want to be watching it, but the only reason you want to be watching it is just for some kind of deviation or unexpected event, basically. Not because we're actually thinking that this could be a decent thing to trade. And then, of course, you'll see we've got crude oil inventories and pending home sales. Again, decent data points to keep an eye on, but all eyes are going to be on the FOMC statement, even though the market's not really expecting it to be that market moving. That brings us to Thursday, July the 30th. And of course, as you can see, we've got stuff coming out from Australia. We've got building approvals. We've also got RBA, the Governor Stevens speaking. Now, it's going to be very interesting to see what Stevens says. Why? Because the RBA are in a bit of a tricky spot. Are they going to follow the other commodity producing nations, i.e. New Zealand and Canada, and keep cutting their rates? We want to see what the RBA are thinking. Are they concerned? They've already expressed some concern, and a lot of people are thinking that now that the RBNZ have gone that way, the RBA are probably going to have to follow suit. So what we want to do is we want to watch out what Stevens says, just for any little clues about his thoughts on monetary policy going forward, basically. Obviously, he's not going to announce anything in this speech, but his tone, the words he uses, the things he says, could be used to give a subtle message to the market about any maybe change in dovishness that they are possibly considering. So definitely worth keeping an eye on. In the meantime, the Aussie dollar is, of course, remaining under pressure. Building approvals is expected to come out minus 0.9 versus previous 2.4. That's only bad for the Aussie dollar. More bad data means more of a sell-off. Look for the Aussie dollar to keep under pressure. You could possibly maybe sell into building approvals because the Aussie, there's no reason to buy Aussie dollars at the moment, although it has kind of fallen quite sharply, so there could be a bit of profit taking. But apart from that, we want to be, let's say we want to be selling Aussie dollar on the rallies, and if there is a rally, maybe look to sell into building approvals, because if it is minus 0.9 or worse, it's only going to keep the Aussie dollar under pressure. It's not a big event. It's not going to get the Aussie dollar moving on its own, but it's just going to be another reason why the market would look to sell Aussie dollars in the current environment of a dovish RBA and pressure on the bank after what's happened with the BOC and the RBNZ. Later in the day, of course, this is probably the second biggest session of the week. We've got advanced GDP from the US. This is expected to come in a strong 2.6% versus a really negative one last time around. Again, expected to support the dollar. Unemployment claims, it comes out regular. No one really cares about that. Advanced GDP, on the other hand, is a big one. Of course, it's one of the big three that everyone, every central bank looks for in their economy: growth and GDP. And if it comes out 2.6 or above, again, we expect to keep the dollar supported. We could look to buy the dollar into this and even out of it if it comes out in line or better. It could be a pretty decent one. So you want to keep your eye on it. It's definitely a tradable event, depending on how you want to do it. And then later in the session, we've got CPI from Japan. And if you just take a look down here, you can see the Tokyo and the National are both expected to be 0 versus previous of 0.1. Now, the Bank of Japan, their target range is 2. Okay, so they want to get that to 2%. They want to do that by the second half of 2016, basically 12 months. Is that going to happen? What you have to ask yourself is, and this is what we're asking ourselves, all traders are asking ourselves, is this: is it likely to go from 0 to 2% in 12 months when it hasn't really moved that much in the last 2 years since they implemented QE? And then the next question is, if that makes sense, surely what's the Bank of Japan's next step? Is it to just give up on QE and abandon their hopes of 2% inflation, or do they add to their QE program and go harder to try and really ramp it up over the next 12 months? My view is that they probably will ramp it up and try and go harder. Now, the Bank of Japan have got a pretty rosy picture of the economy. They've got the rose-tinted glasses on at the moment, and generally, other data from Japan hasn't been too bad, actually. The economic situation is definitely improving, you could say, but this inflation rate is a concern. And I think the Bank of Japan are kind of hoping that the way that CPI is calculated in terms of what will happen with oil prices over the last 12 months, that this will kind of send CPI jumping higher. But bear in mind, these are the core figures, and that takes any kind of volatility from energy-related price moves into account. So you're still looking at a 0% figure. Are the Bank of Japan allowed to QE? I think they're going to have to, no matter what they say. At the moment, they're saying it's not necessary, they're not going to do that. But if you look at the picture for what it is, surely they're going to have to add to it. Surely it's not going to scrape from 0% to 2% in 12 months when it hasn't really moved much in the last 2 years based on what they're already doing. So that's just definitely one to keep your eye on. And it's not the CPI you want to keep your eye on, it's the statements, okay? Because these statements and these press conferences are events that the Bank of Japan can use to announce, extensions to their programs, etc. So keep your eye on the CPI. If it still comes out flat, maybe even dips back into deflationary territory, again, it's just going to make you even more focused, or me particularly, even more focused on those Bank of Japan press conferences and statements, because I do think QE is just around the corner over the next few months, but we'll have to wait and see. And that brings us to the final day of the week. Of course, we've got Friday, the 31st of July. ANZ Business Conference from New Zealand, PPI quarter-on-quarter from Australia. No forecast for either of these, so we'll just kind of see how it comes in compared to previous. So obviously it's not risk events that you can trade into. The big one, of course, is Canadian GDP. Now, Canada is in an interesting situation here at the moment. The month-on-month figure is expected to be flat. The last one was negative, minus 0.1. Canadian data has been appalling lately, with 1 or 2 exceptions. Bank of Canada have cut their rate. They're obviously concerned. Will they keep cutting? Will the data keep coming in poor? If this GDP figure comes in at 0 or below, into negative territory, this could just be another reason to keep selling Canadian dollar. Dollar CAD broke 130. We knew that was going to happen. We've been expecting it for quite a while. If you've been following the news feeds, you'll know that we post the fair values of each currency. And dollar CAD, the fair value of dollar CAD has been at 130 for quite a few weeks, maybe even 2 months. We've been expecting that move to be happening. And this is going to be interesting now, because if the GDP figure comes out bad, we could just see the selling of the Canadian dollar continue, basically. So it could be another reason to get in. Again, not for hundreds of pips, look for a day trade, but definitely could be something you trade out of if we get a negative deviation. Now, you might also notice on Friday, we've got CPI flash estimates coming out and the core from Europe. The core is expected to be 0.8, still below 1%, still below half of what the ECB wants, but it's expected to start stabilising. We look at the previous figures, they were 0.2 and 0.8. So it's expected to start stabilising, which is a good progress. The ECB have already stated they won't end their QE programme early, so it will expect it to run until September 2016, of course, but we need to see what's happening with this CPI figure, because over the next 6 months, if the CPIs get, the core, particularly the core, the year on year starts getting higher and higher, i.e. back towards that 2% level, then actually the markets are going to start thinking that there's going to be a taper and the euro is going to become a buy. Until that happens, euro dollar is still a sell all day long. We want to sell the euro on the back of QE, but you do need to keep a very close eye on CPI, because it's the CPI figure that the ECB are going to mainly be using to determine whether or not to turn the tap off of free unlimited money. And of course, when they do that, the value of the euro is going to go back up. Okay, so just something to keep an eye on. But for now, no reason to be concerned. We're still selling the euro on the back of QE, but we just want to keep a close eye on that core CPI level, just to see how it's coming out over the next few months. Okay, so that's the risk events for the week beginning the 27th of July 2015. Of course, the biggest one for me is the UK GDP. Should keep the pound supporting through the week. Of course, if you get a deviation, you can trade it in that way as well. And then, of course, there's a few other things you want to keep your eye on, which we've been over. So there are a few trade opportunities, either to trade in